option traders, for today's trade we are looking at a bearish option play in Amazon. So taking a look on MarketSmith at Amazon, shares have been in a serious downtrend for the last several months. The stock has been met with resistance several times at its 200-day and 50-day moving averages. Also, the recent sell-off over the past few weeks has occurred in very strong volume, indicated by these red volume bars on MarketSmith. A slumping RS line combined with an RS rating of 15 shows that the stock is struggling much more compared to others, and a composite rating of 34 is another red flag. So with the stock below its 50-day line, investors with a bearish outlook could put on a diagonal put spread here. So a bearish diagonal put spread is constructed using put options, as the name suggests. It's used when investors expect the underlying stock price to fall. So remember, with options, there are two types. There are calls and there are puts. And with both calls and puts, you can either be a buyer or a seller. Just like with any stock, you can either buy it long or sell it short. A bearish diagonal put spread is constructed by buying a put and selling a put simultaneously. This spread is a debit spread, which means that you pay a premium up front for initiating the trade. It also means that the option that you bought is more expensive than the option that you sold. So together, these two options create a spread, and the difference in strike prices creates a specified range. The investor can expect a profit or a loss based on where the stock trades within that range. Another important aspect of this spread is that both puts are on the same stock, but they have two different expiration dates. This is also referred to as a time spread. So let's use an example. Say I have a bearish assumption on XYZ stock and implied volatility is low. This could be a good time to put on a bearish diagonal put spread. Say the stock is trading at around $100 a share. To set up this diagonal, I'm going to look at buying a put with a 110 strike and selling a put with a 90 strike. So the higher strike 110 put is considered in the money because if I own that put, it would allow me to sell the stock instantly at a higher price that it trades at currently. This instant profit potential means the put is in the money. The lower strike 90 put is out of the money, given that the option has no profit embedded in it at the time of initiating the trade. Now, both of these put options not only have two different strike prices, but two different expiration dates as well. The higher strike 110 put that I'm going to buy should have an expiration that's further out in time, while the lower strike 90 put should have an expiration that's nearer in time. Investors can then estimate the profit potential of this trade by taking the width of the strikes, which in this case is $20, and subtracting the net debit paid. So let's say I purchased the 110 strike put, which expires in November, for $15, and sold the 90 put, which expires in August, for $5. That nets a debit of $10, which is my total cost for the trade. The $20 spread minus a $10 net cost shows a profit potential of roughly $10 per share per contract in this trade. So now that you're a little more familiar with this spread type, let's take a look at my trading platform and set up a trade. So here we are on my Thinkorswim dashboard. And first you're going to want to make sure you have AMZN as the ticker symbol. And then you're going to want to make sure you have diagonal selected in your spread type box if you're using Thinkorswim. And for diagonals, you get the split expiration date. So I would just select the December 16th, December 23rd, and we'll adjust the December 23rd down below. And we've got our strike prices here in the middle. I have selected the 80.75 strike right here, and we're going to use this side of the screen because this is where the prices for puts are. So to recap, we are looking to sell one December 16th 80 put and buy one January 20th 75 put. So we're looking at selling a December 16th put with a strike price of 80 and buying a January 20 put with a strike price of 75. The net cost of the trade would be $15, and that is also the most the trade could lose on the upside. The risk for the trade on the downside is a maximum potential loss of $515. The maximum potential gain is around $250, which would occur if Amazon closes right at 80 on December 16th. This trade has a solid profit zone in between 77 and 98. Aiming for a return of around 10 to 15% makes sense for this trade, and investors could also consider a similar stop loss. So the worst case scenario for this trade is a sharp drop in Amazon early on in the trade. For this reason, if the stock drops below 80 in the next few days, consider closing it early for a loss to minimize your losses. As always, remember that if you're new to options, make sure that you practice with a virtual account before risking any real money. And remember that options are complex and investors can lose 100% or more of their investment. Check out investors.com/options for more option trading tips.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.